Welcome back to another episode of Infinite Banking with. Today, we're going to be talking about Pan America. Some of you guys might know this company as MTL. We'll talk about the name change and how that happened. But Alden, I'm very excited. We've been in this series for a while. We've gotten great feedback. We're doing a few more insurance companies before we put a bow on this series. And I'm really, really glad that we get to take a look at Pan American. I want to give a quick disclaimer, and we're going to go down memory lane. My first life insurance policy is with MTL. I still have it to this day. When I got licensed, I went to a boot camp. This boot camp was about teaching people how to use life insurance and pay off debt. That's a whole different episode, another story in itself, but I was very interested in learning more. MTL was one of the companies that this group was using, and I found out that they were located at the time in Illinois, and I was in Wisconsin. And so I ended up getting contracted with them, getting a life insurance policy through them. And then they actually let me come to the home office, and I got to meet some of their people, sit, listen to them take servicing calls. And so they have a special place in my heart from that standpoint. And so this will be good perspective. We haven't looked at them in a while, so I'm very much looking forward to doing this series and them. But just wanted to point that out and also give that disclaimer and disclosure as we get started.
Absolutely. Well, thank you for the disclaimer, Caleb. I'm glad you still have the policy. Let's dive into Pan American Life. A little bit of nuance here, name change and everything else, but we'll get it cleared up in this next slide. So one thing that we'll just say right off the bat, Pan American Life, as well as Mutual Trust, have been around for a very long time. So Pan American is the name of the company that effectively bought and merged with MTL. Pan American has been around since 1911. Mutual Trust was 1904. And combined, because we're taking the legacy of Mutual Trust, a mutual insurance company, into this mix, they've been paying dividends for about 110 years in a row. Now, one of the interesting things, Mutual Trust Life has always been a very well-known carrier in the IBC space. Pan American Life is now championing that same banner. I would call them niched. They're very similar to Security Mutual. IBC is their focus. A thing to mention, just for those who care about the nerdy details, they are a mutual holding company. So Pan American Life Mutual Holding Company is the umbrella. Now, policy owners are mutually in the process of having participating insurance. So you're still receiving dividends. So in our opinion on this, mutual holding versus true mutual doesn't really matter a whole lot as long as the financials and the products are sound for the person buying the product. So one thing as we look into the financial strength and performance, something that was a little bit frustrating is that they do not declare openly their dividend dollar amount or the dividend interest rate. So I, being a geeky, nerdy detail guy, have to go in and kind of extrapolate and pull out the approximate dividend interest rate. So I'm estimating that to be around 6%, could be plus or minus 50 basis points. I don't really know, but they do seem to be paying healthy dividends on their contracts. Something that I did come across is that they do have a higher than average lapse ratio. Now, to be honest, I'm not actually too concerned about that. Whenever we have an insurance company merger, a sale, or a change in structure, we see the preceding really decade or so in a higher lapse ratio because people get concerned, like what's going to happen to my policy. One thing that Pan American has done very well is they are just indicating that this is a long haul decision. Mutual Trust Life was not in financial trouble. Pan American Life was not in financial trouble. They joined markets because Pan American Life has a global presence in the Pan Americas, right? And then Mutual Trust Life had a niche book of business with very strong retention. The partnership just made them both stronger. As we look at the product side and the rating side, we have to understand that the recognition is direct recognition. Now, it's a dirty word in the insurance world. However, we've covered a lot of carriers with direct recognition. I believe they have their place. And in all honesty, it kind of comes out in the wash. So we'll go into a little bit more details on that in subsequent slides. From a ratings perspective, they are a smaller insurance company coming in at a 78 out of 100 on the COMDEX side. We have an AM Best rating of A, excellent. There's two other ratings above that, but A, excellent is very good. And then the WEIST safety score is C. Now, I've done a lot more research into WEIST since our last video on Security Mutual. Security Mutual was a C minus, which is fair, but on the lower half of the fair market. One thing I've learned since is that the WEIST safety score, the magical A, is extremely hard to attain. Very few insurance companies have ever attained that score. So the average for the industry is a C plus B minus, which is kind of crazy to think about. kind of like my grades back in high school. So when we're when we're looking at this as a comparison, New York Life, which is the strongest financial aided carrier we've reviewed, they're an A-. They don't even have the golden A+ or whatever from Weiss. So context matters. Safety score of C. It's not terrible. It's a little bit less than what we would call average. I throw this last part in here, the loan percentage that is currently out of their portfolio, because they are a niched carrier. As you recall with Security Mutual, it was almost a quarter of their entire portfolio was out on policy loans. As you can see down there, it's 23% for Security Mutual. Now, Pan American, they are niched, but only on the block of business that has carried over from MTL, as well as a new block they've been selling since 2015. Only about 12% of their portfolio is out on policy loans, which is kind of in line with the carriers that focus on IBC outside of Security Mutual. They're a bit of an outlier.
Alden, can we speculate a little bit that if we were doing this review, before the merge, that the block of business that MTL loan outstanding would probably be a lot higher? And as a result, when you talk about merging, and neither one was in financial trouble, but if you think about making this both stronger, this could literally be a reason why, because it's better for an insurance company to not have massive amounts of their assets tied up in loans from a cash flow perspective. Is that something that's fair to mention, or do you think that was not one of the pluses in a merge?
I think it's speculation regardless, but I think it's a fair speculation. The parallels that you're drawing, I think, are probably going to be pretty accurate if we went back and were involved in all those meetings. So that's a good point. The interesting thing that I discovered about Pan American, per our regionals, this isn't something we're going to find on any website or publicly disclosed documentation, but they told me that Pan American does a little bit over 50% of their insurance premium into IBC style policies. That's a huge amount. If we compare that to somebody like MassMutual, that's a much smaller amount, right? They're a massive, massive company. And so they are working very hard to continue to be a niche presence in the infinite banking community space. And it seems by over 50% of their insurance premium going into these type of policies that they are succeeding, that they are pushing into the IBC space quite aggressively.
And another question I have is, I wonder if that's another way of saying, high cash value life insurance policies, or if that's another way of saying, hey, a lot of our clients are taking early loans. Like, there's so much to that statement, but I think it is really interesting that they even admitted, like, hey, half of our business is being positioned in such a way where you're putting money into a life insurance contract and then you have access to that capital. And so I wonder over time if that outstanding loan percentage that we showed on the other slide is going to potentially increase if that's the direction they're going. It's just, again, another just question. It's going to be interesting as we do this, as we update, to see what companies are increasing in some areas and what companies are potentially decreasing in others.
Yeah, Caleb's got his speculator hat on today.
Yeah, I guess you're exactly my tinfoil hat here. No, I just love connecting dots, and I think it's important for the viewer to understand. Like, we want to share things, but we want to create context, because I do feel like that is better for the community to learn. Like, hey, no, we want to understand what's behind the numbers. Very much similar to the ratings, because you looked at C in a bubble. You look at if like an AM Best rating of C would be like pretty crazy. But then when you compare, like, hey, New York Life, which is got a COMDEX score of what, Alden?
100.
100, perfect COMDEX score, has an A-. That doesn't, like, that just tells you everything you need to know, that they're going to be rating different. And then the fact that the standard is, or average is C, is like, it's helpful to know. So I think context is important.
Absolutely. And I think context-wise, 50% of their premium, I would say that that's going toward high cash value whole life insurance, right? Because not everybody takes policy loans, but these policy structures are quite common with Pan America. All right. So the legacy brand of Mutual Trust Life is very well known. It's kind of a staple in the IBC community for a lot of the legacy producers have been around a long time. Pan American Life is still trying to champion that same banner. So they are very openly supportive. Their official company marketing materials do reference IBC, although it's not the trademark. It's the insurance benefit concept. So play on words. And they often specifically reference becoming your own banker, as well as Nelson Nash, in the client-facing materials. So they're all in. They're sold. Like I said with Security Mutual, if you want to be wanted, these guys want you, especially for the IBC space. Now, on the whole life side, they don't have a whole lot of products, but the one product that is very well built for this type of design is their horizon value. So high level, the cash value strategy, Caleb, if you want to just give our audience a reminder of the difference in cash flow and front load would be great.
Yeah, cash flow is we're funding out of pocket each year, same amount. And then front load is you're starting with more money the first year and then putting less in year 2. For those of you watching, these numbers can scale up or down. So we just wanted to be very consistent in this series. But just because we're showing $50,000 going in does not mean that you have to have $50,000 going in. I just, again, want to give context because some people look at that and say, wow, I can't even comprehend that. And then some people look at that and say, why did you guys choose 50,000? And so that's the context between cash flow and front load.
Awesome. Well, from a comparative standpoint, cash flow designs in general are going to be more efficient from an internal rate of return perspective long term. Well, why is that? We have to buy less insurance. Whenever we do a front load, we have to buy more insurance for the first 7 years at least to prevent it becoming a modified endowment contract. So in the context of how they perform, early cash value access in the very first year is actually quite strong. It's 85 to 92%, almost 93 in some cases. And so from an immediate cash perspective, this is hitting the target. Absolutely. They do also have the ability to long pay. So we have what seems to be very efficient funding over a very long period of time. What that means really is that some insurance products, like if we go back to look at Guardian's Whole Life 95 product, very strong early cash value. Whole Life 120, very strong later cash value. So their product seems to do both pretty well. They haven't niched into two separate products, which is great. Regarding the growth, average long-term growth seems to top between about 3.5 and a 4.7 internal rate of return. And we'll kind of define that in here in a minute. That's on the cash flow side. Front load's going to be a little bit less, maybe a 3.4 to 4.5, given the current dividend projections and assumptions that we've been using for our models. All right, so diving into the cash flow design, this is going to be the same design we've been looking at a couple other carriers. So it's $50,000 every year for 20 years. After year 20, we are now implementing what's called an offset. So offset just means the policy itself is going to pay for the required premium moving forward. This is different from a reduced paid up. An offset is trying to maintain the premium for the policy and maintain the death benefit as it goes forward. So if we look at this, we'll see over time, once we stop paying premiums, that death benefit just continues to go up because there's so much internal compounding that the policy can easily support that annual premium. So first things first, as we're assessing the initial benefit to the policy, what's the first year cash value? It's that over 90% number. So put in 50,000 by the end of the first year with the dividend, you're looking at about almost 91.5, maybe 92% cash value available to you. From a break-even perspective, we get there fast. It's actually very fast. I was shocked when I saw this for the very first time. We're breaking even in 4 years. Put in 200,000, you've got just over 200,000. You almost do it in year 3, short by just about $2,600 to $2,700. Now, the other metric that I like to look at is what I call the capitalization point. So at what point in the policy can I put in the premium, so in this case, $50,000, and the cash value increases by more than $50,000. That's happening right here between years 2 and 3. So very early on in this contract, now we've reached an efficient point. You put in $1 and that dollar becomes more valuable by the end of the year. And that continues to just roll forward. So Keel, before we start looking at some comparative numbers, I know a lot of you guys are still making notes on, do you have anything you want to clarify as we look at this?
No, I overall, I think that this is a really solid early cash value, break even in year 4 in this illustration. The death benefit increases pretty significantly over this time as well. So I'm very much looking forward when we compare all the illustrations with the assumptions that we gave, because I find that that would be really interesting. I don't know if you have this, but I would love to know, like, what are the minimum on these policies?
The minimum on this policy is ridiculous. The whole life insurance charge itself is about $1,800 per year, and then it's got some term insurance blended on top.
Wow. Very, built very efficiently.
Yeah, absolutely. So for those tracking and wanting to pay attention to the future value, although we are going to put everything into a big Excel sheet for you guys, is out here at year 20, we're looking at a projected about almost $1.6 million of cash value. The death benefit side, just shy of $3.9 million as well. So these are very healthy benefits. I've said before, in most IBC style overfunded whole life policies, we should see the death benefit double roughly every 10 years. And it's actually doing more than that. In the first 10 years, it went up by 120%.
Hey, I'm interrupting this video briefly to say, if you're serious about using whole life insurance for infinite banking, we have a free gift for you. It's called the IBC Company Guidebook, and it gives you inside access to the data behind these videos. Things like life insurance company COMDEX scores, their dividend performance, how they approach infinite banking style policy designs. It's all the information we cover in these videos organized in one place for easy reference. To access the guidebook, click the link in the description or pinned comment. Now let's get back to the video.
Now, transitioning into that front load design Caleb talked about, $100,000 the first year, $50,000 a year through year 20, and then the same offset as we were looking at in the other illustration. First year cash value is still very strong. It's around that 91 to 92% number. And as you can see here, the death benefit is basically double what we were looking at before. Okay, well, why is that? Well, just putting in double the premium. We got to get the MEC limit up high enough to justify to the IRS that this is still life insurance and should be taxed as such. So that $100,000 premium going in creates a larger death benefit and a lot of very quick capital access. Now, the interesting thing is we almost get to a capitalization point in the second year of this policy. If we look at the growth between this year here, year one, and then year two, it's almost $50,000. It's about $49,000. But we definitely get their capitalization point between years 4 and 5 with some room to spare. So on the front end, an extremely efficient life insurance policy, getting to the point where it overcomes the cost of insurance very quickly.
This is a really efficient looking illustration, and it's cool to see that the death benefit increases and everything looks very standard. So yeah, I appreciate you putting this thing together.
Yeah, absolutely. And for those taking notes, going out there to year 20, got a $1.66 million on the net surrender value for the cash value, and about a $4.8 million death benefit at that time as well. All right, now that you've seen some specific numbers in the illustration, how do we actually get access to the cash value? Security Mutual, as well as this company here, Pan American, they're niched. This is the community they want to serve. So we're looking at very fast loan initiation. Up to about 10 days after funding, you can initiate a loan request. Now, as we discussed before, Pan American is direct recognition. They do adjust the dividend that's being received on the dollars that you're lending against. That is a variable loan rate system, and you're charged interest in advance, like we saw with some other carriers that I'll mention here again in a second. One of the interesting things that I found, even though that they are a very niche carrier, the only way to initiate a loan other than calling the carrier is to fill out a online fillable PDF form. So maybe that's going to change in the future. I think it probably should, given the trajectory of all these insurance companies getting a little bit better technology, being able to request loans online through a portal interface. But the fillable PDF does still work fairly well, goes directly to the carrier for processing. Loan repayments as well can go directly to the portal, and there's no weird dollar cap like we saw with one of the last carriers that we reviewed. So loans go directly back to the carrier through the portal. And the loan itself, while it is based off of an annual interest rate, the interest is charged all in advance. So on a $100,000 loan, you're going to see a $5,000 interest charge if your interest is 5%. And that's going to go into the portal immediately. Some carriers accrue the balance over time. Other carriers like Guardian and One America, they come in and charge it in advance. It comes out the exact same. Our stance is like, doesn't really matter, but daily accrual is a little bit easier to understand for most clients. All right, now this is honestly one of my favorite slides. Talking about flexibility of these products is very important to me, to us, to the clients that we serve. PUA flexibility for this carrier is actually very good. The one downside, because every carrier seems to have one, is that these guys don't have a catch-up provision on their PUA rider. That said, they've got a minimum premium. Every single year, you got to pay at least $100. I think most people can handle that. And then on the high side, whatever your underwritten maximum premium is, you can play in between those two markers, minimum to maximum, at any point. I will say that they are targeted toward a smaller premium market because the maximum PUA they'll allow per year without underwritten exemption is about $100,000 of PUA. Then this phrase here, the anytime payment, is something I've kind of coined. Apparently no one else calls it that. I was told that in the comment section of one of my last videos, but I like it. Anytime payment, you can do whatever you want. They don't limit the number or the consistency of your payments into that rider as long as you hit your minimums. Now, something that's interesting about this particular carrier is they offer a specific dividend option called maximum dividend accumulation option. This MDA, this option is really designed to scale back the dividend if needed and put the money elsewhere in order to prevent a MEC. So when you're running maximum blend policies, one of the hypothetical risks, I haven't seen it, I have heard about it, is if the dividend increases too rapidly and you're funding too close to the MEC limit, and that dividend isn't buying enough death benefit, the policy may MEC. We may cross that boundary. So this is just a protection mechanism that they've built into one of their dividend options for these style of policies to prevent that from happening should the dividend increase too drastically one year and the death benefit not be enough to substantiate the 7-pay rule. Now, two quick things to know is that they do have a waiver of premium and you can add the PUA rider. So caveat though is that they only cover about $15,000 of PUA. But if you think about it, if you get a disability, one of the things that 401k is not going to do for you is continue to put in your paycheck every month. With a whole life policy, with a company like any of the companies we work with, waiver of premium provides that continued building of that asset if you're disabled. They go a step further, like some of the carriers we work with, and add the PUA option up to 15 grand, continuing to overfund it on your behalf as well. Pretty cool rider. Only a couple of carriers do offer that, but there is an extra cost for it that is based on the total premium amount. Geographical coverage as well, so they're available everywhere except for New York. You know the reasons. We talk about them a lot. All right, so as we start to land the plane here, we're going to go over some advantages to Pan American and then some considerations as well. So first and foremost, over 110 years of dividend history, very good. They're also very pro IBC, so your communication with the carrier, your policy going through underwriting, these designs are very well known, so it should be a fairly smooth process along the way. Their PUA rider, in my opinion, is extremely flexible, and their lightning fast loan initiation just makes it so that you can get to your capital very quickly should you want to very shortly after funding. It's very similar to Security Mutual in that way. Now, something that surprised me, because coming into this, I knew this was a small carrier. It used to be MTL, now it's Pan American. They've had some changes, but they actually are very competitive. So smaller insurance carriers in the IBC space, when you compare them side by side, so I'm thinking Ameritas, One America, Security Mutual, they're actually performing from an illustrated perspective better than those three. They're very close to Lafayette Life Insurance, exceeding 90% cash value in the first policy year and competing very well long-term. So that did surprise me. That's why there's an asterisk there, because it blew my mind. Now, something that I really do appreciate about this product as I reviewed it is honestly the most simple whole life product that I have seen for this type of insurance structure, where we're maximizing the PUA. We've got very simple term insurance riders, no gotchas on the PUA about how it operates or works. And the base chassis is just whole life insurance. That's the simplest product in the insurance market. And so I was very impressed from that perspective. Very simple product. It would be my number one spot for PUA if it had a catch-up provision. So Pan American, if you're watching this, help me out here. might be beneficial.
Yeah, I'll just say this, Alden. It was going through this, we chatted, and I definitely think the merger and the intentionality to their niche is showing, because, don't take my word for it, but I do believe that the long-term illustrations, and again, they're illustrations for a reason. That's, I think, the other thing that we're going to talk about is just the size of the company and the ratings. That's something that people have to be able to, lean into when it comes to who they decide to work with. But overall, it seems like the merger has not only made them stronger, but it has allowed them to create more competitive products. And I just want to give hats off to Pan America, because it's been a breath of fresh air to see this. And I know that we're in the Infinite Banking series, but I also know that there's many people that use their modified endowment contracts for college planning and all. And that'll be for a different video, but I do know that they have a very competitive product as it relates to that. So I think it's important to not only pick the right company, but then pick the right strategy and ask the question, does this company, do they build, do they accept, do they want this type of business? And so that would be like my thought processes. It would be nice maybe if they allowed maybe more convenient ways to get loans, especially since they're embracing IBC. But then at the same time, do they want to make it that much easier to take a loan? Maybe, maybe not. But overall, the fact that their PUA flexibility is super flexible, which is something that more people need to talk about, and the fact that they very much embrace this type of business, is great. And I, again, have nothing but amazing things to say about the people. I've had nothing but great interactions with the people at Pan America, formerly known as MTL, because I was interacting with the people that were representing MTL before they merged.
Thanks, Caleb. So let's go now into the considerations. So there's 4 of them that I pulled from the review that I did. The first is that they are just a small mutual insurance company. Now, size doesn't always matter, but I feel like sometimes it should. And when we are reviewing all these companies side by side, I get to see the different assets, the different balance sheets. They are the smallest mutual holding company that we have reviewed, although they are a little bit larger than Security Mutual. So they're kind of on the smaller end of the entire spectrum, obviously dwarfed by Mass Mutual and New York Life, and even smaller than somebody like One America, but they're not the smallest company that we've reviewed. The lapse ratio, as I said before, it's a consideration. Perhaps it's not as big of a concern because of the shift that we've had from MTL to Pan America in the last 10 years, but it is the second highest that we've seen in this series, behind Security Mutual as the highest. The other 2 considerations is that there is a small policy niche. So if you're wanting to do over $100,000 of premium, it might not be the right carrier because we can't get that much into the PUA. So your policy will not be as efficient, can't overfund it to the same degree. And then finally, as I mentioned in the advantages slide, PUA is great. With no catch-up provision, it's a bit of a con, and there's some other options out there in the marketplace to make sure you do have that option as well for missed premium to refill previous years.
Yeah, and to be fair, Alden, I think that there's really 3 considerations, but because you're OCD, you wanted to add a 4th just to even it all out. I think the consideration or maybe con would just be something that would be nice, but most carriers don't have as flexible of a PUA deal. And so I would still acknowledge that MTL, you're doing a great job. If you get a catch-up PUA, that's going to be a cherry on top. But I very much want to just acknowledge the small policy niche. If you want to come in with putting millions of dollars in a year, MTL is just not going to be the carrier that you'd even consider. And then the last ratio is something to look at. And then the size, for better or worse, they're depending on your situation, depending on your belief, depending on the diversification. It's just something to be aware of. But there's, outside of their COMDEX score being under 80, it's not like there's anything crazy alarming. It just is sometimes you can't have a perfect COMDEX score if you're not massive. They're definitely showing that in their ratings.
So to give a bit of an agent perspective, the initial compensation for this carrier is average. Most of the carriers we work with are average. They all start out around the same. But some of their higher GA contracts, so based on your production, how your company is structured, you actually are able to get up to 125+% compensation in the first year on first year premium. That's pretty strong. That's very strong for the insurance industry. Product complexity, this is the most simple product I have reviewed. So I give it a 2 out of 10 because I'm hoping out for a 1. I haven't seen it yet, but maybe it's out there somewhere. From the resources perspective, I'll call it average. Now, full disclosure as well, I haven't sold any policies with Pan American. Caleb's policy years and years ago, I think, is the one that we have access to at this point. And so I don't know, I'm going to call it average. I will say that their internal teams that I've communicated with for making this video after the research, they all know about IBC. They're trained on it. They understand how the underwriting works. They understand how to answer questions on the phones in the service center. So that is a good resource and support for your clients and for yourself as an agent. And then the illustration software is, I think, average for the company size. So where do we land? Well, in conclusion, because Pan American is a small to mid-sized mutual company, their product is amazing, but at the same time, they don't quite compare to some of the larger insurance companies out there. In their space of the small mutual insurance companies, they are quite competitive. I would put them very similar to Lafayette Life being a lot bigger and more established in that comparison. So having the most simple whole life product on the market and being very pro IBC, the biggest thing against them is that their comparative size and their financial ratings. And then to just quote my good friend Nelson von Hayek here, the product, its design, and your understanding are what matter most. The carrier choice among top mutuals is secondary. Caleb's got his policy. It's doing what it's supposed to do. It's a solid whole life product. So at the end of the day, carrier choice is second.
It was one of the very first loans that we documented at Better Wealth. And for those of you that really are, go down memory lane, that Greg Kielema was one of the founders of Better Wealth and unfortunately passed away. There was a death claim that was paid, and MTL was that company that he had on his life. So I think it's a not only company that I still have that I've used, but it also is a company that has, has literally paid a claim. And I don't wish that on anyone. And yet your conviction increases big time when you start seeing death claims come out, because it just really helps solidify why we do what we do. And so I think the summary is perfect. And I very much look forward to those of you that write and sell MTL, and to hear more. And as we are putting on our annual event, it's always great to get different insurance companies involved. And I'm excited, Alden, to continue to update year to year, because it'll be interesting to see trends. And so MTL is one of those companies that we'll have to keep an eye on, because they're doing a lot of things right.
Absolutely. Well, Caleb, this has been fun. Glad we got the opportunity to review Pan American. Thank you to the team that I worked with to get all this information. You guys were great. We'll see you on the other side.
Hey, if you have a policy that you want us to review, whether it's MTL policy or a different policy, we would love to review it. Obviously, we put on this series to educate, but we know a ton about policy designs, and it really comes down to, again, the quote above, how you use it. And so we'd love to look at your policy. And so if you have any questions there, if you want to talk to us about getting a life insurance policy on yourself and what this would look like, having an infinite banking style life insurance policy, we'd love to help you and work with you. And then the best thing that you can do is, if you're not subscribed to our channel, to subscribe, to comment, because it not only tells YouTube that this was valuable, but it helps engage with the audience. And then if you are subscribed, if you hit the little bell notification, you'll get notified when we drop videos. And not only is this series amazing, but we're working on more series, and we're working on some really awesome interviews. So we'd love for you to be the first to know about that. So that's how you can help us. And if we can help you, there'll be links down in the description and pinned comment.